Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back, everyone, to Macro Minutes. My name is Peter Schaffrik, and I will be your host today. The time of recording is 2 p.m. London time, 9 a.m. Eastern, and today is the 4th of April, 2023. The last two times when we met here, we were talking a lot about financial turmoil, SVB, Credit Suisse, and the odds of whether the tentative wobbles that we saw in markets and in these institutions would morph into a systemic crisis. Financial market volatility exploded, bank stocks were falling sharply, credit spreads widened, and rates market reversed a lot of the implied rate hike implications that we had built in prior. The primary market for corporates and specifically financials froze. Now, looking back over the last week and a half, the picture looks much calmer, or at least the market collectively is breathing a sigh of relief and is desperately seeking calm, which is also the title of today's edition. So I think the debate has moved on quite a bit actually already from how much financial tightening will remain as the result of the volatility that we've seen, and whether this can be offset at least to some degree by less rate hikes than we previously assumed. Just overnight, the RBA has just followed the Bank of Canada and paused its rate hiking cycle. Short-end rate expectations for most of the other markets where central banks are still in hiking mode have now stabilized, but at lower levels than about a month ago. So for Sonia, as the forwards, they all are pricing about 50 basis points less rate hikes than at the end of February. And in my mind, the debate will next move to whether the combination of tighter financial conditions as a fallout from the volatility that we had and lower rate hikes than we previously assumed will be sufficient to seriously dent the economy and, crucially, the labor market. And because of the lags, given that this question is unlikely going to be answered in the near term, the recent newfound tentative stability in the market led to a sharp drop in realized and implied volatility already. And I expect this trend to continue, barring any further blowups. Longer-dated Treasury, bond, gilt yields have all stabilized now, and credit spreads have started to tighten again. Equity markets, including the battered bank stocks in Europe, have recovered again. And I think this is sort of what we're trying to investigate today a bit more in detail. And to help us navigate this difficult landscape, I'm joined by a strong roster of RBC experts. So we'll start off with Gwinn, who will talk us through the latest developments in the U.S. And he has recently written a very insightful note about deposit flows in the U.S. banking system and the draw on the Fed's liquidity provisions. He'll start us off. He's going to be followed by Taor. He's our head of European DCM and Syndicate, who will walk us through the developments in the primary market, which I have pointed out repeatedly are a key part of the financial conditions debate. Jason Dorr will share his views on the U.S. and Canadian bond market. And we'll finish off with Adam Cole, who can hopefully shed some light into what this all means for the U.S. dollar and other FX pairs. So without further ado, I'll turn it over to Blake.
Yeah, thanks, Peter. So, look, I think it's been helpful in talking with clients to kind of break down this recent banking stress into kind of three different components here. This just helps kind of clarify, the arguments, clarify the discussion. So, the first impact I think we have that the Fed is concerned about is really contagion risk. That was how interconnected are these banks to the financial system? Are these banking stresses going to trigger some kind of broader fear that's going to turn into broader banking issues and really kind of turn into broader systemic risk, similar to what we've seen, great financial crisis, something like that. I think the second aspect here is really the degree to which this banking stress has really been a harbinger of other troubles to come. So not so much that these banks were interconnected into other areas of the financial system, but more whether these are kind of a sign of difficulties that are going to come because of the Fed hiking rates. And then lastly, I think, is the issue of the credit condition tightening. To what degree are we going to see a broad pullback by banks, credit creation, and to what extent is that going to drag on the economy? From the Fed's perspective, I think they're very confident on the first of these. I think, we're essentially 3 weeks on, and we really haven't seen any signs that stress is broadening out to other banks. aside from the liquidity provisions that have been tied to the bank failures, most of the borrowing that we saw from the Fed and the FHLB system here in early March looks to have largely been precautionary. We don't really see that demand, broadening out, getting larger, more increased, more demand for loans or advances from the Fed or FHLB. And already we're seeing, seeing that stress start to fade to varying degrees across these various products. On the second piece, whether or not this banking stress is really a harbinger of other troubles to come, I think you can construct a decently convincing narrative that these were very idiosyncratic issues, relatively isolated issues of mismanagement, rather than some kind of early sign of broader fragility that's going to come because of rate hikes. But I don't think the Fed can be entirely sure of that. So these doubts are likely to linger, and I think all else equal do help to keep the terminal rate in check. Lastly, on the pullback in bank credit provision, that is almost certainly going to happen. But the magnitude of that pullback and what that pullback is actually going to mean on the broader economy are still very, very uncertain. This uncertainty, more so than the other two items I mentioned, is really why I think the Fed pulled back from a 50 basis point hike in March and left their 2023 dot at 5 1/8. There's been a lot of effort across the street to kind of express this pullback in terms of rate hikes. To be honest, we don't have a major view on this, and if anything, I think kind of relating hikes, which work through the demand side, to a tightening in lending, which is really going on the supply side, seems a bit fraught. But, if we look at what the Fed did, if we assume that they were going to increase their 2023 rate projections but didn't, we can imply that their initial thoughts are that this is worth something in the order of 1 to 2 hikes. And if we look at how market pricing shifted, that's suggesting that this has been worth 2 to 3 hikes as well. For our part, we still see the Fed hiking in May and then pausing at 5 1/8, consistent with what the Fed said in their most recent SEP. However, we do wonder if the market's too quickly put down the possibility for a return to the narrative that existed in early March after Powell's congressional testimony, before all this banking stress started. We could certainly envision a scenario where no other shoes drop on the banking side. Confidence that these recent failures were idiosyncratic starts to broaden. Banks start to tighten financial conditions, but it really doesn't drag on the economy to the extent many are expecting. We get data that can be used to meet or exceed expectations. I would say also oil continuing to rise. If all those conditions, take place in the next 2 to 3 months, we could certainly see a scenario in which the Fed hikes in May, keeps the door open, and that the terminal rate comes back into play, which we think markets would really view as increasing the risk for a hawkish policy error. So that's not our modal view, but I think it's something that's certainly a risk that is meaningful enough for people to keep in mind and something that should be hedged against. So I will leave it there and pass it along.
Thank you, Blake. That's very insightful, as always. And with that, I'll hand it over to Taor to speak about the developments in the primary market.
Thank you, Peter. I guess if you look at the primary market, particularly in Europe, and look back on the first quarter, in fact, before that, look at where we ended last year. It wasn't necessarily going to be an easy quarter. Interest rates were still going up. We were nowhere near terminal rates. Yields were rising. Inflation was sticky. And I think the outlook for most issuers, looking back at November, December last year, was that it was going to be a very tricky first quarter. But actually, things panned out pretty well. I think partly because cash had built up. There hadn't been a great deal of supply in the fourth quarter of 22. And as yields rose, investors actually thought it was a good time to put money to work. So for the first 2 months of this year, things were pretty consistent and pretty steady. And conditions in primary, whilst maybe new issue premiums slightly wider, conditions were generally very good. The markets were open most weeks, most days, which is very encouraging. You need a good first quarter in DCM. And then we hit March. And again, beginning of March, treasuries were just above 4%. Bunds were heading towards 3%. They're roughly 2.7%. And then the first full week of March, that's when Silicon Valley Bank was effectively taken over by the FDIC. The week afterwards, the ECB put rates up as expected, but then that weekend, Credit Suisse ended up being merged with UBS, and the week after that, you had the Fed putting rates up, the Bank of England putting rates up, etc. And things came very quickly to a halt. But what really struck me is how quickly Europe recovered, not just in isolation, but compared to other markets. Normally, Europe follows the US lead. The US is a very deep market, very deep investor base, very large issuer base. But actually, the US was pretty quiet mid-March, whereas Europe actually plowed ahead, pretty much business as usual. It wasn't plain sailing every day. But for example, the week the Fed put rates up, the day the Bank of England put rates up, VW came out in the euro market. It was a transaction we were involved in, and ended up printing $1.75 billion across 3 and 6 years. And demand was huge. The order book was just shy of $6.5 billion. And that was in a market where perhaps in previous years, access to funding, and it really is key, access to funding was questioned, but it was definitely available. And really since then, we've seen a continual and fairly speedy improvement in conditions across all asset classes. Last week, for example, in the US, 25 billion printed. In Europe, 17 billion worth of investment grade. Of that, 7 billion was corporates, 10 billion financial institutions, plus another 13 billion in SSAs. So a 30 billion week in Europe last week, which again, for the end of the first quarter, is a really strong week. Admittedly, in financial institutions, of that 10 billion, the vast majority was covered bonds. And I guess if you look at the issues around Credit Suisse and the banking sector in general, it really shouldn't surprise anyone that the bulk of issuance has been covered. The question really is, when will the senior market reopen? When will the subordinated market reopen? And dare I say it, what about A Tier 1? Well, this week is a good example. Just a few days later, there's a European bank, BNP, in the market with a senior non-preferred transaction, and they have demand over $2 billion. They've tightened the pricing 20 basis points, and it's gone incredibly well. AXA in the market today also with a Tier 2 transaction, again, gone incredibly well. The book over $4 billion. So it seems to me as if investors have really put the troubles that we saw in March to one side, and they've seen rates which dipped down. Don't forget bonds, which were, as I said, around 270 or so, dipped down well below 2%, about 190. They're back up now at 230. I think investors see this as a really good entry point, and they haven't seen the wall of supply really over the last 2 or 3 years, and perhaps that's partly more down to economic conditions than demand. Demand is still incredibly strong. New issue premium is back now in just 2 or 3 weeks to pretty much normalized levels. But the last stat I'll leave you on, quarter one, where does Europe figure compared to previous years? Well, you look at total issuance, covered bond space, pretty much the same as last year, about 80 billion, slightly up on last year, but roughly aligned. Senior space, actually, 90 billion in Europe has already printed this year. That's up 50% year on year. That's an incredible number considering how tough it was across March. Corporate space, up, maybe small, pretty much flat. Not necessarily always a busy month in January, but normally a good month. But year on year, pretty much consistent. And SSA is incredibly strong, partly because the spread to core government yields is so high given where swap spreads are. But overall in Europe, Q1 2023, 517 billion worth of investment grade issuance. Not only is that a high number, that's the highest number the market has ever seen. It's a record quarterly issuance, and up 10% year on year, and that compares to the US market, which is down about 15%. So all in all, I think going back to your original question, Peter, have the markets recovered? Well, not 100%, but they're arguably far stronger, far quicker than really almost anyone predicted. And do banks, corporates, SSAs have access to funding? Absolutely, 100% they do. So I guess my summary is very, very strong market in Europe, very strong demand. Investors, when they choose to come, have seen still very high order books and can drive the price down 10, 20, 30 basis points from initial guidance to final landing spot. So in short, it's been a very strong Q1. If I look forward, there's no reason, I've got to caveat that and sort of touch wood, there's no reason why, certainly in the short term, that won't continue, because investors are seeing terminal rates quicker and they're seeing where we are in terms of spread and yield and improving credit conditions as a real positive. I'll leave it there, Peter.
Thank you, Sean. That all sounds quite encouraging. And with that, we'll move over to North America again, and I'll hand over to Jason Doe.
Okay, thank you very much. As Peter mentioned to start the call, markets are indeed calmer over the past couple of weeks, but a calm market's not necessarily a feel-good market. So what's particularly interesting to me is that, in the U.S., the, regional bank index, remains close to its lows, and U.S. dollar IG senior and subordinated bank credit, it has tightened from the wides, but it's still a decent amount away from the levels from a month ago. And when looking at government bond space, after popping higher, bond yields in U.S. and Canada, they're close to revisiting the lows that were reached on March the 24th. So I think what's happening here, at least in government bond space, is that, after the flight to quality flows, the reversal of volatile market conditions, is the realization that the economic damage from tighter credit conditions that was in place in the second half of last year already, and now compounded by probably more tightening in credit conditions by small banks, does present a real risk to the growth downturn being larger than otherwise. So, when you look at, how important small banks are, they have loaned more than the larger banks in the U.S. over the past 2 years, and especially in areas like commercial real estate and also in the residential sector. So, the upshot, I think, is that, bond yields, should be biased lower through this year. You can have a situation where they move higher, but it's probably not sustained. So I do think this year is all about being long duration, and you just need to pick your battles on size and timing. Another factor that, could fuel the push in bond yields lower, is short covering, or I think maybe even more importantly, the lack of dry powder to add to shorts. So when you look at the CFTC data and the information on speculative accounts, they're still quite net short U.S. fixed income. And, this is corroborated by what we're seeing in leveraged fund returns. So, yields leaking lower, could, be helped by the positioning angle. The topic I wanted to talk about is the outlook for Canada. So we do maintain our view that the Bank of Canada will be on hold in 2023. The business outlook and consumer outlook surveys that were released yesterday did provide a sigh of relief because when you look at what's been happening in Q1, the labor market has been quite strong, and Q1 growth is tracking, to the strong side also. But the outlook surveys, which the bank puts quite a bit of weight on, and the forward-looking information there, is telling us that things are moving in the right direction regarding inflation expectations and production constraints. So that does support our view that the bank will be on hold probably this year. When you look at market pricing, the chance of a small cut by July and almost a full cut by September, we think seems out of place versus the macro data, and would really require an escalation of the financial stability risks. So fading near-term cut pricing does still continue to make sense, but we wouldn't fight the 2 rate cuts approximately that are priced into the end of 2023. By the fourth quarter, yes, the chances of a rate hike or rate cut would probably start to increase quite significantly. And while our base case is the cutting cycle should start in Q1 next year, obviously that's splitting hairs, Q1 versus Q4, but still between now and Q3, the chance of a rate cut is very unlikely, we think. And with that, I'll turn it back to Peter.
Thank you, Jason. As always, very insightful. And our last speaker on the FX market is going to be Adam. Adam Cole, here you go.
Thanks, Peter. So in his introduction, Pete said we look at the outlook for the dollar and for other currency pairs. And I hope going forward it will be more of the latter and less of the former. So just looking back, after 2022, which was just wholly dominated by dollar up or dollar down, up for the most part, for the first quarter of this year, quarter just ended, in fact, the dollar has barely been a theme. In net terms through Q1, the dollar index was down just 1%. And the high to low range through the course of Q1 was just 5%, half the range of the previous 2 quarters. So from FX, it does feel like we have left behind this very dollar-driven market that we lived with for the whole of 2022. And I think, as we've talked about before, so long as we can leave behind this environment of co-movement of equity and bond markets, then that can probably stay the case. It was the parallel sell-offs in bonds and equities last year that really pushed us into this dollar directional quadrant of returns in FX. And if we can re-establish a little bit of negative correlation between bonds and equities, so that dollar direction should fade. So where do we look for that going forwards, and what are the themes that will play out if we do have, as Peter highlights, a slightly calmer asset market background, and we don't have these parallel sell-offs in bonds and equities that we lived with for last year? And I think there are two themes and at least two trades that come out of them that we come back to in FX in an environment where interest rates and interest rate spreads have widened but start to stabilize. The first is yen underperformance, one of the big themes of last year, which I think is still valid. And that is all about the level of rates rather than the dynamic in rates, and how the investment world has changed for a yen-based investor suddenly faced with hedging that costs after almost 20 years of almost cost-free hedging, suddenly in losing FX risk costs. And that, bottom line from that for us, is that it's yen negative. It leaves domestic investors sellers of their own currency. And then the second theme I'd pick up is if rates and markets generally can stabilize, something we really have to focus on a little bit more is the dispersion of interest rates in levels terms. Even just within developed markets, we've not seen this degree of dispersion across markets in front-end rates, not just back to pre-pandemic, but back to pre-financial crisis, is how far back we need to go to find an interest rate, a level of interest rate dispersion as wide as it is now. And that, combined with a relatively calm asset market environment, does suggest to us that we should be thinking a little bit more about carry in the G10 world. Not to the extent that carry dominates our world, as it did back pre-crisis, but that it's creeping onto the agenda as a viable FX strategy. So a couple of trades we like on the back of that over the medium term. One is to be long New Zealand and short Sweden, two currencies that have very different yields but very similar risk characteristics. And then if we broaden it out to G10 EM crosses, to be long Mexico and short Canada. Again, wide spread and volatility suppressed, as the fundamental drivers for both of those currencies are in many cases similar. So those are the two themes, I think, in this calmer environment that we come back to, is focusing a little bit more on the level rather than the rate of change in rates. And that makes us negative on the yen and positive thematically on carry. And with that, back to Peter.
Well, thank you, Adam. So I think what we've learned, or at least what I've learned, is as long as the market is calmer, we don't get any spillovers into other asset markets again, and that's certainly the indication at present, as Blake has highlighted. The primary market remains open and remains quite active, and that's a positive sign. Nevertheless, whether or not this has any long-term ramifications for the economy remains an open question, and therefore, as Jason has highlighted, it's always difficult to fade the implied rate cuts further out the curve. And certainly what Adam has highlighted is that whether or not we get co-movement between bond and equity markets is crucially important for where the dollar is going, but also as long as the level and the dispersion of rates is relatively wide, this opens up the possibility for carry trades in the FX market. With that, I thank everyone for listening in, and I hope you're going to join us again in 2 weeks' time for Macro Minutes.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.